Hello, and welcome to My Finance Teacher. Here we're going to talk about what do central banks do. So first of all, the goals of a central bank. There are a lot of things central banks do. There are a lot of tools that the central banks have in their monetary policies. But all of the things that central banks do and all of the tools that they use are supposed to help central banks in achieving four goals. The four goals of central banks are to moderate inflation. Although some might argue that central banks often create a little bit too much inflation by perhaps increasing their balance sheet substantially, by perhaps printing a lot of money. After all, the central bank is the only bank that can actually print money. A second goal of the central bank is to promote employment. Of course, we don't want to have too much unemployment. And perhaps the government with its fiscal policy is more responsible for employment rather than the central bank with its monetary policy, but it's also one of the goals for the central bank as well. Similarly, another goal for central bank is to promote long-term growth, long-term economic growth, and to moderate business cycles. Business cycles is this fluctuation in our economic activity, fluctuation in GDP, fluctuation in unemployment, when the economy is growing during an expansionary phase, and sometimes, of course, GDP drops, unemployment increases when the economies enter a recessionary period. Let's say we have time on the horizontal axis, and let's say we have economic activity, the amount of economic activity on the vertical axis. You might think of it as, say, GDP. And with time, sometimes the economies are doing well during expansionary periods, and recessions come sometimes, as in, say, 2008, 2009 global financial crisis. Then the economies tend to grow out of the recessions, and another recession comes usually every 4 to 10 years. The most recent example of a crash is this pandemic. So as you see, the ride over here is very bumpy, going up and down, up and down. One of the goals for the central bank is to smoothen this ride a little bit, make it less bumpy. Compare the blue line and the red line. Blue line is less bumpy. Central banks might actually support the economy by providing more liquidity during the recessions and perhaps preventing bubbles when the economy is getting overheated by reducing the liquidity. But again, some might argue that central banks are lately reluctant to reduce liquidity when the time comes to do so. Next, let's have a look at central bank balance sheet. What do central banks hold and what are the liabilities that central banks have? Looking at the asset side of the balance sheet, central banks most often have some sort of government bonds that they buy with newly printed money, and central banks also provide loans to commercial banks, to regular banks. The money that the central bank provides to commercial banks would, of course, be the asset for that central bank. And of course, there could be some other assets central banks hold. On the liabilities side, what are the central banks liable for? Well, central banks create all the currency in circulation, all the paper money that you have in your pockets are created by central banks. That is a liability for the central bank. And it was a more true liability about 100 years ago or so, when the population could exchange this paper money back into, say, gold if they wish to. Currently, of course, fiat money is not really supported by the ability of the population to convert it back to precious metals. And another liability that central banks have on their balance sheet is the reserves of commercial banks, is the money basically of commercial banks that the commercial banks hold with the central bank. According to the regulation in most countries of the world, basically, commercial banks must keep at least some part of their assets, some part of their reserves with the central bank. And that is, of course, a liability for that central bank. Now, to sum up the liabilities side of the balance sheet of commercial banks, what we have is the sum of currency in circulation and reserves of commercial banks held with the central bank. Both of these have actually been created by the central bank. The paper money that you have in your pocket is created originally by the central bank, and the reserves that commercial banks hold with the central bank have been typed into existence using the keyboards of the central bank. And all of that base money, all of that starting amount of money that the central banks create is actually called monetary base. As we'll find out soon, that's not all of the money that's actually circulating in the economy. We'll find out that magically commercial banks, even though they are not allowed to print money, can actually increase money supply starting from this monetary base. How does that happen? We'll talk about that a little later. Now, coming back for a minute to the goals of central banks. There are 4 goals, and the central bank tries to achieve these goals using its monetary policy. And within its monetary policy, there are several tools that the central bank can use in achieving its goals. There are 3 tools, which are open market operations. That's basically a name for the actions where the central bank either buys government bonds with the newly printed money, hence increasing the monetary base, hence increasing the money supply in the economy, or sells government bonds, and the money that is received by the central bank for the sale of those government bonds is actually withdrawn from the economy, hence that's how central banks can decrease money supply. Lately though, over the last at least 10 years or more, generally we haven't seen central banks selling government bonds. Perhaps sometimes central banks allow government bonds to mature, to expire, but all the way since the global financial crisis, the monetary policy has generally been loose when central banks didn't actually sell any of the government bonds. In fact, we'll see that the central bank balance sheets have actually been growing with central banks buying a lot of government debt. Another tool that central banks have is providing loans to the commercial banks. This tool is also contained in the phrase that states that the central banks are the lender of last resort to the commercial banks. What it means is if the commercial banks don't have any other source of liquidity that they can resort to, they can always come to the central bank and ask for liquidity, because it's the central bank that can simply print money into existence, providing that liquidity to the commercial banks. And the third tool that central banks have in their toolbox is changing the required reserve ratio. Again, according to the regulation in most countries of the world, commercial banks are required to have at least some part of their deposits in the form of reserves kept with the central bank. And if this requirement is increased, meaning that its commercial banks have to keep more of the deposits as the reserve with the central bank, it will reduce the commercial bank's ability to provide loans out of those deposits that the general public brings into the commercial banks. That will also generally reduce liquidity in the economy, reduce money supply, and vice versa. Reducing this requirement, reducing the required reserve ratio, generally loosens the liquidity, increasing the money supply. Next, let's throw in some numbers and have a look at a couple of numerical examples of what exactly happens to the central bank balance sheets and the balance sheets of commercial banks when the central bank uses these open market operations to either buy government bonds or to sell government bonds. So let's start with buying government bonds, increasing money supply, increasing liquidity in the economy. So let's start with this balance sheet for the central bank, where it has government bonds and some loans to the commercial banks. There are some other assets as well, currency in circulation, reserves of commercial banks with the central bank. And we have a couple of commercial banks, Bank A and Bank B. The commercial bank balance sheets are identical in this example. Commercial banks have reserves that they keep with the central bank, 200 of reserves for commercial bank A and 200 of reserves of commercial bank B. That's a total of 400 in reserves. The banks provide loans to the general public. That's loans on the balance sheet for the commercial banks. Banks can also hold bonds, say government bonds and corporate bonds, as well as other assets. On the liabilities side, the banks have deposits, the money that the depositors deposit into the bank, and the banks can borrow from either the central bank, which appear on the central bank's balance sheet on the asset side, 100 borrowed by commercial bank A from the central bank, and 100 borrowed by commercial bank B from the central bank, the total of 200 over here. And commercial banks can also borrow from each other or from other corporations. Let's say they borrowed from other corporations over here, and the rest is the equity or the capital of the commercial bank. Now let's say the central bank wants to increase the money supply by 300, and whatever is the measurement, whatever is the units over here, perhaps that's in millions, billions, trillions, whatever it is, the central bank wants to increase monetary base by 300. It wants to purchase 300 worth of government bonds. neither Bank A or Bank B have as much government bonds. So let's say, for example, the central bank is going to purchase 150 worth of government bonds from each of the commercial banks. What's going to happen to the balance sheet of the central bank is that central bank is simply going to type more money into the reserves of commercial banks that it's holding, increasing this from 400 to 700. That's adding 150 to each of the commercial banks. And in return, it will receive 300 worth of government bonds. So the amount of government bonds the central bank will hold will increase up to 1,100. What's going to happen to the balance sheets of the commercial banks is that instead of having government bonds, they'll have more reserves. So the liability side is not going to change. It's that one type of asset will simply transform into another type of asset for each of the commercial banks. Each of these commercial banks will only have 50 billion in government bonds, and the reserves will increase to 350. So reserves increase to 350, government bonds decrease to 50. What that means is that commercial banks now have a little bit too much cash that they hold. Perhaps they don't want to hold as much cash, as cash doesn't generate profits. Perhaps they will use this cash to buy more securities or to provide more loans, hence injecting more liquidity into the economy. And that is how commercial banks will magically create more money without the ability to print more money. They'll create more money in addition to the 300 that's been typed over here into the reserves of commercial banks by the central bank. But we'll talk about that in a minute. Next, let's have a look at what happens to these balance sheets, to the banking system, when the central bank sells government bonds. So let's say the central bank wants to sell government bonds for the value of, let's say, 200. That's selling, let's say, 100 worth of government bonds to each of these commercial banks. On the asset side, the central bank will have less of government bonds. That's down from 1100 to 900, decreasing the amount by 200. The monetary base will also increase by 200 because in return for these government bonds, the central bank will receive cash, will reduce the amount of reserves that the commercial banks are holding with that central bank. This reduces down to 500 from 700. Monetary base decreases, the amount of liquidity in the economy decreases, and in exchange for that liquidity, in exchange for that cash, the banking system, here consisting of only two banks, Bank A and Bank B, will receive more of government bonds. These are the changes to the central bank balance sheets. The changes to the commercial banks balance sheets are that they will have less reserves, from 350 down to 250 each, and the amount of government bonds increases by 100 up to 150. Similar change to Bank B. A decrease in reserves and an increase in government bonds. So that's only a transformation of one asset into another as a result of the central bank selling government bonds to the banking system. Now, if we back up just for a minute, when the central bank was buying government bonds, let me just show what happens to the balance sheet when that happens. As you perhaps already noticed, the balance sheet of the central bank increases. The asset side as well as the monetary base, they both grow as a result of buying government bonds, as a result of printing more money and providing more liquidity into the economy. As we had in our first example, the government bonds that the central bank holds increased from 800 to 1100 as a result of buying 300 billion worth of government bonds. And for these government bonds that the central bank receives from the commercial banks, it will credit the amount of reserves that the commercial banks have, increasing that from 400 to 700. And as you see, the monetary base increases from 1050 up to 1350. That's a growth of the asset as well as the liability side of the central bank balance sheet. A relatively significant growth over here from 1050 to 1350. That's a growth of nearly 30%. But what do you know? If you actually look at what central banks have been doing recently, this is the Fed, the central bank basically in the US. You'll notice that over the last year or so, the size of the balance sheet of the Fed, of the central bank, has basically nearly doubled. As you see over here, this is the chart for the total assets of the Federal Reserve, increasing from 4 million, and that's in millions, so that's increasing from 4 million millions which is 4 trillion, if I'm not mistaken, up to nearly 8 trillion. So that's nearly double the amount of monetary base. What do you think that is going to do to the economy over the next few years? Let me know in the comments below.